Welcome to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of speaking to Dr. Jim Thorne. Jim is the Chief Market Strategist over at Wellington Altus Private Wealth. Jim's been on the podcast a number of times, so we're happy to have him back as a returning guest. So let's get into it. All right, Jim, welcome to the podcast again. Thanks for being here.
Thanks for having me. How about those Oilers?
How about those Oilers? I think the last time we saw you, we actually attended a game out in Vancouver. So that was fun.
Well.
Yeah, it didn't go that well, but I think we made it. We made it out of the stadium alive. I think that was the important
part. I was there. It felt like I was watching a Leaf game.
The 3-goal come from behind win, or was it 4? I don't even.
But here's the inside poker is the fact that you know Connor Brown, who scored the goal, the shorthanded, his dad is the coach of the Toronto Marlies, which Connor McDavid played for, and Zach was on that team and he couldn't make second line, so his dad basically went and got him another team, which was the Toronto Red Wings. These guys, at least a Toronto group of guys on the Oilers, have known each other from Pee Wee hockey, which is how small the world is up here.
Yeah, for sure.
Yeah, the hockey infrastructure in the Toronto area is phenomenal. I didn't realize that some of these wealthy guys own their own teams and sell them after their kids are done, and moving on to the next generation of parents who've got money. It's crazy.
Hence, Mr. Hyman bought the Toronto Red Wings for Zach to play in the top 2 lines, right?
Yeah.
Well, someone did make a comment about that. I can't remember back when he kind of was close to hitting 50 goals, and I think he got a lot of flack for that because someone said, "I don't care how much money your parents have, they can't make you into the NHL. You have to be able to persevere and do it yourself."
Yeah, but those, I would say, at least now I'm aging, but the GTHL, there's those top 6 or 7 teams that you guys took kind of like right over the target. It's not only can you afford the skates and the lessons, can you buy the team, right?
Yeah, no kidding.
Sounds like the Mag 7 all of a sudden here.
Yeah.
So what? Tomorrow night's the game. Yeah. So it's that's like 4 o'clock. What time? It's 6 o'clock here. It's so
6 o'clock here. Yeah.
No, that's 8 o'clock out west. I'm going backwards with my time.
Are you guys going to the game?
I'm going. Yeah. So lucky enough to have tickets from before, but they're going for $7,000 a ticket now. It's insane.
Well, it's oil country, so you guys got lots of money, right?
They somehow sell it out every night.
And B, it's I don't know. You guys got the Connor McDavid is really stepping up. Very impressive what he's done. Very impressive.
Yeah, amazing. Yeah, the last game at 8-1 was just a riot in there. Like, it was electric.
Yeah,
you don't get that many. It's kind of weird to win 8-1, but be down 3-1 and have the same amount of goals. You did
well. I watched the New York series with Florida, and if any team loses their edge, the level of the parity is such that the other team, if they kick into the high gear, they can win a couple of games, and that's where we are right now. I think the Oilers are going to win tonight, or the next game 6, and I think it's going to go to game 7. Then in a game 7 for the Cup, anything can happen.
Anything can happen. That's right.
Yeah. Well, kind of like what was that hockey movie way back when? The joke one.
Oh,
Slapshot. Someone might take their skate off and cut another guy. I think that was one of the comments, wasn't it?
Oh my gosh.
Yeah, so I mean, we could go deeper and deeper into the Oilers here.
Oh yeah.
The fun stuff.
Yeah,
you've been a busy guy with lots of different videos. You've rolled through the states and gave your spiel and kind of let them know what side of the planet we live on and what you're thinking. So that's great.
Oh, thanks. Yeah, I mean, it was good. It was good being back in New York, connected with a lot of old friends. And I think the one thing I would say to you guys that I come away with is that A, we are over the target in our views, and B, how early we are. One of the biggest unforced errors that we do as investors is we sell our winners too early, right? It's really hard to do the work, get positioned correctly, and then we think it's over, and it runs another year to a year and a half, and so I honestly think, and we're just to recap, the economic growth we're experiencing isn't real. It's all fiscal. People know it. We need to go to a period of fiscal responsibility. That means economic growth is going to slow. Rate cuts are going to happen. They've already happened in Canada. We can tip our hat to Mr. Macklin for doing that. Rates are going to go lower than you expect. And in that type of environment where you have an inverted yield curve, you buy secular growth, like we've been talking. That's the game plan, right? It's the same thing with the Oilers. I mean, the first couple of games, I couldn't believe they were playing with the puck around the blue line, right? And doing Christ-sized play. You get the puck over the blue line and shoot it in. Now they do, they win. Well, here the rule is inverted yield curve, buy secular growth, breadth narrows. This isn't cold fusion, guys, right? And everybody is going, oh, what about the magnificent this and blah, 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 that? And it's like the Fed has raised rates to extreme levels to slow this down, to counterbalance the uncontrollable fiscal spending out of Washington, D.C., and Canada, out of Ottawa, okay? That's coming to an end. Typically, we get a growth pocket or an air pocket like we did after World War II or World War I. Comes down, growth comes down too fast. They cut rates too much. We get deflation, and then we go and reaccelerate. So I would suggest to you that this time next year, we're possibly talking about the S&P 500 around 6,500. And it's going to be the same crew, the same winners. And then I really think at that point in time, we need to start talking about getting a little bit defensive this time. So I think right now what's going to happen is people are going to start, there's going to be differences, right? There's going to be people are going to open up their statements at the end of the second quarter, north and south of the border, and a couple of things are going to happen. Clients are going to open up and they're going to realize the massive underperformance of the TSX relative to either the S&P 500 or the NASDAQ 100. And they're going to ask either themselves or their advisor, what the heck is going on? Why am I, so loaded into Canada, right? And that's the home bias, right? Okay. And then what's going to happen in the down south is the same thing, only they're going to be diversified, right? We sell this thing in our business about you need to be excessively diversified. And yet when you look at guys like Warren Buffett, right? He may have sold Apple Computer down, but he's got like 45% of his portfolio in Apple. And when Coca-Cola was his thing, right, it was like 50%. So Mr. Buffett has concentrated portfolios. Guys, you go back to the 1990s and somewhere it's about 2.39% of stocks generate all the performance. Let's make it 3%, right? And we'll use the S&P 500. Guys, that's 15 stocks, right? That's 15 stocks. So own the right stocks. They've over-tightened. We understand that people are behind the eight ball and are complaining. We're going to have a catch-up trade, I think, this time as the year goes out, because people are going to have to try to get back some of the performance, and it'll be interesting to see how they do it. And then I still think the first 6 months of next year to the first 3 quarters of next year are pretty constructive. And I think we see the highs of this period of time in that time frame. So, and this is a hypothetical, like just say September next year, S&P 7,000, let me just hypothetical, right? And it does a 20% correction, goes back to 5,700. You know what I mean? It's going to be something like that. But we're going to have a correction in the horizon. Let's start talking about it and getting prepared for it. But we don't really have to do anything about it right today.
No. Well, what's interesting, at least from just some feedback we're getting, is, we are very underweight Canada. And thanks for that. Your help kind of guided us. Well, we were on it a few years ago, but, we kind of made some adjustments. But what's interesting is we're getting some feedback from clients now who open their statements and they think it's time to push their chips and bring them back in and go to the cage and get cash because they're worried we're getting a correction right away. And it's kind of like, how do you respond to that just because they've done so well?
Well, can you do me a favor when they call you up and say, I understand risk and I want to go in and I want to take my line of credit and we're going to buy a bunch of these, these meme stocks, right? That's perfect. I hear that, guys, and I get really bulled up, right? Nobody believes it, right? Nobody believes it. So I would just say, stay the course. This AI trade and the blockchain crypto thing, it's the biggest evolution, generational thing that we've ever seen. We're early days, right? I mean, Elon Musk has just connected with Dell Computers and Supermicro to build out the state-of-the-art, brand new server farm, right? GPU. So Elon's got all this data. He wants to feed it into these supercomputers to learn. That's where we're at, right? It's not, ChatGPT, where it's not like these large language models. I mean, we are just in the early stages. The way I describe it is in the 1800s, we took water, we applied heat to it, and we got electricity. Or we took an atom, we applied heat to it, turned it into steam, and the steam turned it into an electron. Right. And then the electron became electricity and we started trading electricity. And then, we lighted cities, we had appliances, radio, TV, think about all the stuff that's getting done. Now we're taking the electron, which is electricity, and we're converting data into intelligence.
Yeah.
And we haven't even got there yet. We're just sitting here going, we got the chip, we got to build the building, and then we're going to do that. So it's going to be lots of fits and starts. AI is going to change and revolutionize the way things are done. Bitcoin and blockchain are going to change the way the payment systems work and the way that property rights are traded. Right. So we're so early. Is it going to take maybe to the end of the decade? I think we're pretty good on the end of the decade. And the only reason I say that is because of demographics. The millennials and the younger generation are going through the same type of a lifestyle phase as the boomers did, right? They're family formation, they're buying a house, they're saving for retirement, they're saving for the kids' education. They are where the boomers were in the 80s and the 90s.
Yeah.
Right. And although we talk about the 90s so much, some of these stocks feel like, Intel and Microsoft back in the 80s. Yeah. And that's how big this could get. Right. And the skepticism, at least in New York City, is still very high. And so that's the one thing I took back when I came back is, man, like, I said to myself, people say, what do you think? I go, we're early. And I don't think we realize how early we are. I think people don't realize that the majority of folk are not positioned for this.
And and I'm not picking on your age here. You've been doing this for a long time, and to have you kind of I wouldn't say on the forefront, but your belief and your understanding of how big this is. I mean, when we look at, our clients who are boomers, let's say, we're not going to get into a massive blockchain, crypto, AI discussion with them because they have, they're set in their ways sometimes. They have a hard time looking at this like something that happened in their time where we had an explosion of market growth and ideas. And I think people just aren't buying it yet. I mean, we see it, we understand it, and we get it. But boy, passing that information on to a group of people is foreign to them. So I guess
that's how early we are in the cycle. I think in the 40s, one of the big innovations that came out of World War II was the transistor or a transistor radio, right?
Yeah.
Can you imagine trying to explain what a transistor is to an investor when you say, well, we got this tube, right? Your
I don't even
radio's
think I
got
can
this
explain
tube, and then, now it's on this little transistor,
That's what
right? And so you just, why am I bullish? Because when they phone you guys up and say, I don't know what the heck it is, my son-in-law just told me, I'm all in. You know what I mean? And you don't have to explain to them. Then you sit there and go, guys, this is getting spooky. Like, let's take some risk off the table. And it's just a normal psychological, evolution, right? It's what we do, right? And I think the quote I always use the quote I have for the next Market Insight, I use Mark Twain. And it's really about the fact that, and I'm paraphrasing, but you can tell somebody a lie, and you can tell them a lie frequently and they'll buy it, but tell them the truth and try to get them to change their mind with facts. It's a losing battle, my friend.
Yeah. I look at our portfolio, the way it's been designed. I look at our risk metrics, all of the normal stuff. And, the risk metrics and things for the past 4 or 5 years are no different than if we just plopped it all on the TSX. But yet the return is, double at least of that. So because, we're always trying to adjust our equities for risk and things of that nature. But, you got people sitting in a very similarly risk portfolio making nothing. And it's interesting. Why would you take that risk on when you're not making anything?
Risk is perverse. And, Kahneman and Tversky, in behavioral finance, that's why they won the Nobel Prize, right? It's people get freaked out. People view losses differently than gains. And but you say to people, like, let's look at traditional media. And I don't want to name any names. All right. So let's just traditional media, period. It's not that the traditional media companies aren't having people view their platform, right? As we are told, more people are watching TV than they ever have. Okay. What the nuance is the fact that they do not have a monopoly on advertising, so they can't charge as much, right? And B, they levered up their platforms with excessive amounts of debt. So their business model is no longer as profitable as it was, let's say, in the 1970s, right?
Yep.
Fair. I'm not. So you sit there and go, well, what happens? Well, you sit there and go, well, how do you get rid of excessive levels of debt? Right? And it kind of comes into what we're talking about with our society. We've got to look at people can say all they want. They can say whatever they want. It's a free country, free speech. You can invest however you want. But if you talk to somebody that does not build their investment thesis off of the fact that we have debt levels, the level we have not seen since the Napoleonic Wars, and we cannot survive at 5% interest rates. That's a fact. That's back of the envelope math. Hey, I grew up in Scarborough, okay? Right? For those of you who have been transplanted from Toronto, you know what I'm talking about, right?
It's me, yeah.
And so, look, we've got excessive amounts of debt. How do you solve it, right? Even the Congressional Budget Office just came out yesterday. It's all interest payments on the debt, right? Are we going to cut entitlements to senior citizens, to healthcare, to education, to the military? No, we got to get rates down. This period of excessive spending by Mr. Biden and Mr. Trudeau, justified or not, let's just leave that over there, whether it was justified or not because of COVID. Okay, let's just leave that over there. It's unsustainable. It's unsustainable, and we're going to go through a period of payback. Invest accordingly. That's all.
Yep.
Right?
I would agree. It's interesting though that like you said, you could debate the increase in spending because of COVID, but then you wonder, okay, it's over. Why are we still spending at the same levels? So something is going to break, and it's breaking already. But I'm not quite sure that everybody's ready for what can happen from all of this. when things have to change.
Yes, we've got a big bank. We've got a big bank in Japan having to liquidate U.S. treasuries. And this is one of the biggest banks in the world that deal with collateralized, debt obligations, right? And, we've got the spreading out of the yields in France because of the snap election that Mr. Macron's called because of the loss of the European elections. And so, you see me when I email you guys and talk, but with this amount of debt, right? If they don't cut rates, something is going to break, right? It's just a matter of time, right? And if it does break, you're not getting the genie back in the bottle, and in 25 basis points doesn't mean anything, right? So in all this period of time about, risk on and stocks are going to outperform in the U.S. and secular growth, I'm not Pollyannish to the extent that if the Fed doesn't start cutting rates, there could be a really significant crisis on our hands. Bank of Switzerland just cut for the second time. Bank of Canada cut. I think they're going to cut at least 3 more times this year. I think, and let's be honest here, right? I think Tiff Macklin, I wish he would have moved earlier because, it's all about the inversion of the yield curve, right? So short-term money is more expensive than long-term money. I'm sorry, credit creation is really simple. It's, borrowing short and lending long, right? So we know that credit creation is stopping. That's like the oil to the engine. It's only so long that you can run an engine without oil. And then once that you seize it and the pistons lock, you're toast. And that's what's going to happen to the economy, right? So we know that's happening. And then once you pour the oil back into the economy, or once you get the yield curve, so short rates are higher than long rates, then it takes about 18 months. So 25 basis points. So let's look at this. We're at 475 right now for the overnight rate in Canada. And the 5-year bond, government bond, is about 340, 350. Correct me if I'm wrong. They could cut it. They could cut by at least another 100 basis points and still have the yield curve inverted, which is kind of like the best way I can describe it is we're back in my parents' backyard, right? And we're playing with the hose in the summertime, and we've kinked it, and the water's not getting out. Okay, so we've moved it a little bit. The water's not getting out. We've got to straighten the hose out, and then once they straighten the hose out, that water's going to run for 18 months. Guys, that's taking us into 26. Think about that, right? I mean, so they've made the mistake. The cement has been poured. Why are we arguing? So I go to New York and I say, what are we arguing about? What are you talking about? It's over, right?
What is the argument for keeping it higher? I mean, I have trouble finding any relevant argument other than, that we have to curb housing, we have to get the prices down. Like, I don't get it. I'm not sure what the intention is.
If you have to, so I'm going to focus on Tiff Macklin because I'll say, look, I'm about his age, right? And he went to Western, I went to York. We studied the same stuff. It's the same textbook. It's the same articles, right? So you get to advanced macroeconomics, and you know that basically hiking rates are inflationary and restrict the supply side response, right? Nobody should be surprised at looking in the United States today to say that housing starts have stopped, right? There's no credit creation, right? I phone my buddies in the States, and there's no new construction happening on the East Coast. Or it's not getting financed, right? So he's got to know that. I think it comes down to is, they're worried that Joe Biden and Justin Trudeau spent like drunken sailors. And they wanted to counteract the excessive spending, irrational spending, and ensure that inflationary expectations were well anchored, which they are, right? And so, I think the way this is all going to the negative aspect of this is the Fed's going to start cutting a couple of times and people think it's going to get fixed. Well, guys, guess what? You've driven 100 miles with no no oil in your engine. We got to do a ring job, right? We got to pull the pistons out. We got to do a whole engine rebuild, right? I don't know what the damage has been done, right? And we won't know until we at least get some oil back in there, right? We get the yield curve steep. Credit creation happens. It may be fine. There may be nothing wrong, right?
Yeah.
But I think we're going with debt, demographics, globalization, and technology, all deflationary forces. I just don't see us entering back into this new inflationary environment. So I think that's why I think, I could be wrong. But I think interest rates we're going to go back to a pre-COVID environment where growth is going to really slow. And you're going to have a real tough time trying to get inflation over 2%, which means you're going to have low rates. And we're going to start talking about pushing on a string. And then we're going to be talking about, are you surprised that all these guys 3 years ago said that, we're in a new inflationary environment and higher for longer and yada, yada, yada. And I'll say to you and the other guys say, no, because that's the dumb money that listens to MSM, right? Mainstream media. That's the dumb money that listens to the sell side research on Wall Street, right? If you come to Wellington and you come with us, you may not agree with us, but at least you know that we're talking about it and we're kicking the can around and we're thinking about it.
Yeah. Well, that's a big thing. We lean on that all the time of why we're different and what we're doing here. So I think your message is always something that we can leverage and discuss. And, there's just always some good talking points. And most of the time the clients are looking for that information. They hardly even want to talk about their portfolio sometimes. They just want to talk about the future of what's coming down the road. What's the world looking like? They don't want to discuss the 25 things we have in their portfolio mix. They want to discuss what the world's going to look like.
What does it look like when you got robots manufacturing everything, right? They're transacting with each other using a crypto like Bitcoin, and they don't need us, right? Mm-hmm. Productivity goes through the roof. There's none of this work from home stuff, right? They're working full time. They're working, and what does that look like? What does our society look like? Right? Are we going to allow that? The changes that we're about to enter into have been talked about for a long time, and they have profound effects on our society. What does our government look like if we apply AI to the government? I mean, think about that. I know you're giggling, but yeah.
No,
what happened if we actually got some rationality and common sense in Ottawa?
I
don't know, but every industry, every industry is going to be affected by it. And so all I know, and it's we're going to go back to the Luddites, right? These are the guys that Ned Ludd. Ludd was the guy that broke the the sewing machine for silk stockings. Right, way back in the artisans, right? And everybody was freaked out that innovation was going to replace workers, right? And every innovation that we've had from that period of time, we've been able to, as humans, retool and find other jobs to do, right? Well, is this the time when the Luddites are right? I'm not that good, guys, but we're going to have that conversation. Right. But for our clients, it's, you've got the winners. You don't need, they're creating money with it. It's not like the 90s when there was no earnings and we were valuing companies on clicks. Right. NVIDIA's got real earnings and are growing real. Like this is real. Like this is tangible. This is nothing like the shenanigans in the 1990s, right? Yeah. And so for us, I think we've got to the end of the decade to have a really nice bull run. Yet, with so much debt, you can never rule out, a short-term little shock. Something blows, right? In '98, it was Hong Kong blowing. They came after the Hong Kong peg, and 18 months later, it ended up being, Russia defaulting on their debt that almost took out Wall Street, like something like that. But when you get lots of debt, right? And listen, let's be clear. Nobody was positioned for the Fed to go from 0 to 5.375% for Fed funds rate. Nobody was positioned for that. So all these banks have zombie portfolios, right? If they had to market today, like the Fed has to get rates down or this thing blows sky high. Let's just be the math. The back of the envelope math says we cannot survive. So I think they know that. I think they're going to manage it accordingly. I think they waited longer than they expected because I don't think anybody planned for the amount of fiscal stimulus that happened after COVID. I really am concerned, guys, about the fact that the Fed and the Bank of Canada will not be as willing to do what they did during COVID ever again and trust the politicians. I think they've learned. I think that to me is a risk no one's talking about. I don't think the Fed or the Bank of Canada will ever write a blank check for the government ever again in our lifetime, right? They've done it. And I don't blame them. I have the fiscal spending should have stopped in 21, right? Now we got, is it going to stop? I mean, the sugar high is going to be, have you guys ever tried to quit caffeine? Right? Coffee? Yeah. Do you know what the withdrawal? Remember, it's just this basic withdrawal. Now I know you got, but, quit smoking, the withdrawals are going, that's what we're about to go through with this fiscal stuff. As far as I'm concerned, it's the withdrawals of it all, my man. It's going to feel like heck.
Well, the government must be like me, huh? Don't try and quit anything, and then you don't have to worry about it.
Well, you know what the funny story, guys, is here in Ontario, there's a guy, the premier is Doug Ford, right? And he wants to call it an early election, right? Unlike Trudeau that wants to try to stretch it out, right? Yeah. Ford basically is going to call, he can call late 25 or early 26. Ford, they know that this is not going to look good in the back half of 25. The math is there. If Doug Ford and his team know, right? So to me, it's the evidence is there. I think the shock is going to be the fact that the damage that has been done to the private sector is a lot worse than we think. Fiscal spending gets back to a normal cadence, and people realize the damage done in the private sector, and the private sector doesn't turn on a dime, right? If all of a sudden, going back to my old days of working in the States, you get to the point where you get the call from HQ saying, okay, we can start lending again, right? You get the call, you guys are in Edmonton, right? You get the call from each quarter saying, okay, boys, you can start lending. You can do $3 million locally and you can sign off on that. And anything above 3, you got to go to senior loan. Okay, good. Yep. Start writing business, right? That takes, once you start doing that takes about 18 months to get into the system.
Yeah. Wow. Right? You look at even our business clients. Depending on their age, some of them have just come to terms with, this is my business. It's not growing. And I'm not gonna do crazy things to try and make it grow anymore. I'll just keep things going the way it is, and I'm gonna be gone. soon enough from this business. So I haven't seen anybody's business really growing dramatically out of the people that we have.
It's going to be, I'm just going to stick my big toe into politics for 1 second. I want to talk about another famous gentleman from Alberta, Mr. Carney, Mark Carney, right? And he gave a really good speech in April, and he simply said that and it's true. You can't redistribute what you don't have. I am paraphrasing Mr. Carney's words, right? But I just, on my political side, and I'll just echo what Mr. Carney says, is you and I, we can argue we live in a democracy and we have to have redistribution and blah. I get that. That's Canada. I get it. But this era of, modern monetary theory, where you think that we can just create money out of thin air electronically to justify income redistribution between the rich and the poor, that's coming to that is going to be a hard reality for some folks to get their head around. We need to grow the private sector so that we can get the tax base, so that we can do all the things that we want to do as Canadians, right? And which are uniquely Canadian, but we are not a Marxist communist society. And I think that our current situation has come to the fact that some folks in Ottawa have lost the plot in that. In the United States, it's different because look, and this is why I'm much more bullish there than I am up here. The only reason why the United States is separating itself from the rest of the world, it's the innovation. I mean, they are the innovative leaders. People say, well, why do you love Canada? Why don't you like Canada as much as I like the United States? Well, I go, okay, I'm a fisherman, right? I want to go to the pond that's got all the fish. And it's not to say I don't like this pond over here. There's no fish in it, right? We have no innovation up here, right? Innovation is Shopify, right? One thing, the banks are going like this to crypto and blockchain, right? So you tell me, in an innovative environment, where's the best place to put your money or your client's money? Well, how about, the NASDAQ 100 or the S&P 500 or the S&P 100, where you've got, you got NVIDIA, Lam Research, Dell Computer, Micron, Microsoft, Apple, go Meta, you go boom, 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 and you get all these names. You got Lilly, and so you've got all of these massive companies that are growing irrespective of policy in Washington, D.C. That is the unique aspect that the Americans have as opposed to us in Canada or the Europeans. So until that changes, I'm not that smart. Go to the pond that's got all the fish.
Yep.
Agreed.
Yeah, and I keep doing some reading around, can these big name companies, the top 2.8% that you've mentioned, Jim, can they keep carrying the market forward, or do we have to get the markets developing some breadth and depth, getting growth from other industries? And, it sounds like your comments are like, no, I mean, we've been here before. Do we really need to have other companies carry the line here? In the past, in the 90s, we've had companies just pull it all by themselves.
Yeah. So how this is going to work when we get to the fundamental aspect of it, that earnings matter and fund and cash flow matters, and they do. Well, let's just use the example of what Elon Musk did, right? Elon Musk phoned up and said, I've got all this data. We're going to go, I think it's to Nashville. We're going to build the state-of-the-art supercomputer, AI server farm, right? This is what we're going to do. I called Supermicro, I called Dell, I got NVIDIA, and we're going to build that thing, right? And they're the first. Look at all the construction and look at all the stuff that's going to go into that in terms of power and cooling. We're going from air cooling to liquid cooling, like everything. So every company that is going to be exposed to that build is going to have fantastic earnings. So we go from the aspirational phase where the CEO of NVIDIA puts up a chip to now Elon basically saying, I'm building it. And then everybody else going, this is winner take most in our environment. Everybody's going to be replicating it. Think about the build there. So the build and the economic growth is going to be in a one very narrow sector of the economy, and the tentacles are going to start going out, right? It's just like up there in Edmonton. We found another tar sands. We found another shale oil field that we're going to exploit, right? We find it, and then all of a sudden, look at all the businesses that benefit from that. That's how this is going. So that's companies like Quanta, right? That's companies like Eaton. That's companies that will, that's why utilities, the XLU in the United States, right, is going, right? Because people are going through and they're saying, okay, this, and they're working down the vertical, right? We don't have that up here.
Yeah. Right.
And so, first off, this is what happened in 2003 when we had the China urbanization trade, right? And Canada benefited from that, right? And I think the thing that Canadians don't understand is this isn't a question about Canada being a wonderful place to live. It's not. It's being a question about, can you change your bias in terms of investing and be honest with yourself? That the period of time between 2003, when we had China urbanizing and consuming massive amounts of commodities, benefited us. And then we had the global financial crisis. And the high quality of the Canadian banks that shielded us from the catastrophe that happened, or the catastrophe that happened in the United States and Europe and elsewhere in the world, we had none of it. And then what we benefited from was China levering their balance sheet from 0 to about 54 to 55 trillion. Right? That's over. That phase is done. Okay? So does it mean that we're doomed up here? No. But I think what we need to be as honest with ourselves is that the last 20 years, we ain't going back to that, guys. Stop it. Oil's trading between 70 and 80, 70 and 90. The oil companies are going to be fine. They're going to have huge amounts of free cash flow. Their dividend is safe, right? Natural gas companies are great. You know what I mean? We're fine. But it's not going to be a growth industry.
Yeah.
And it's how much of it is of the TSX, right?
What, 17? What is it now?
Yeah, and in the States it's 3 or 4.
Yeah.
Right. So you could own 6. So if my reference point is the S&P 500, for example, sure, I love energy, but I love energy relative to I'm using the US playing field. And this is what I would suggest. If you have to stay in Canada, fine. Here's what I want you to do. I don't agree with it, but this is what I want you to do. I want you to take the sector weightings of the S&P 500 and apply them to the Canadian market. And in the areas that you cannot fulfill, right, you go to the United States. Just do that little game, okay? Do that little game. And so when you sit there and go 35% tech, just take that and buy the NASDAQ 100, right? Don't have 30% in banks. Don't have 20% in energy, right? And if you're going to have if you're going to have materials, it's not all, I love gold, but they have chemicals, right, in the United States and materials. And if you want to have utilities, look at what the U.S. utilities that are on fire are not the same as Canadian. Right? And will it come to Canada? Sure. Will it be as profound? No. And so my point of view is from an investor. My point of view is trying to give you advice, teams advice, where I say, well, let me ask you a question, guys. When somebody comes in for a plan, do we say like 7%, 8% return on a balanced portfolio? What do you benchmark? If it's a 60-40, what's your number?
4 to 6.
4 to 6. If you want to get 4 to 6 in a balanced portfolio, it's easier to do that if you're allocated into the United States in your equity.
Yep.
And that's all I'm saying. And can you do it by picking stocks specifically for Canada? Sure. Just harder. That's all.
Yep. Very true.
Very true. Awesome.
Good.
Well, Jim, I think we've run pretty close to the end of our time. As usual, it's enlightening speaking to you. We always enjoy our conversations, and we're always very thankful to have you take time out of your day and spend a little bit of it with us. So thanks again for being here with us.
Thanks for having me, guys, and go Oilers.
Yeah, go Oilers. If you want to learn more about Dr. Jim Thorne, you can certainly head over to our website and follow us on our socials. Jim, thanks again for being here, and we'll chat with you soon.
Take care, guys. Be safe. Have a good summer, okay?
You too.
Thanks. Take care. Bye-bye.
Bye for now.